So the first thing one should get right is to protect your important information. So thinking about putting in place non-disclosure agreements, confidentiality agreements is really important, because ultimately that is valuable to your business, and you don't want someone going and taking that information and using it elsewhere. You also have to think about the sensitive information that you are disclosing. What type of information are you disclosing? Is it personal data? Is it employee data? Is it particularly sensitive code, for example, or particularly sensitive information that you don't want other people to get and use on an unauthorized basis? From a practical perspective, as well as putting in place a document to protect that information under an NDA, you can also think about the key practical steps, which is, okay, when should I disclose this information? What do I need to redact from it? E.g. employee names, sensitive data, and that type of thing. Because ultimately the best protection you're going to have is not actually disclosing something until till the last minute when it's really crucial. Okay, so yes, the next phase is indeed the due diligence stage. And that's where it's the buyer's opportunity to do a deep dive into the target itself and look at the various contracts, etc. What that looks like and how deep a buyer might indeed want to dive into the business really does depend on where the value sits within the business. Is it a property-heavy company? Is it dependent on key IP, for example? Is it a wealth management business which holds sensitive client data, is regulated, etc., etc. It really depends on what a buyer wants to do here. So, some buyers might be more risk adverse than others and therefore want to diligence everything. Others will take a slightly more or potentially a pragmatic approach and say, okay, I'm just going to focus on those areas where I see real value, or indeed where I see higher levels of risk. From a regulatory perspective, particularly those businesses in the financial services industry, a buyer's going to want to know about the regulatory permissions that a target company has, what it can do, and importantly, what it can't do. And the buyer will want to understand not just what happens at that present time, but also they'll need to understand what they want to do in the future. So they'll be looking at their future plans, future forecasting models, etc. And they'll be saying, okay, is this particular target company fit for business, for the type of business I want to run going forward as well. Due diligence, never a short process, so always beware that it's going to take longer than you expect. But getting that diligence process done right up front really does help then drive some value later on the transaction, because on the buy side, you either see that these are the problem areas I need to fix, or indeed, actually, there's too much risk that I don't want to go ahead, so you can manage your costs. Or indeed from a sell side, that's your opportunity to actually really sell your business and say, actually, no, look, here's my company, here are my key contracts, etc. And getting that right up front can really help you further down the line on the transaction when it comes to negotiating price and indeed the transaction documents themselves. So in terms of the FCA and how it works, it's the buyer that's going to need to make that application to the FCA to be approved as a new controller of the business. The target company itself will have its own obligations to notify the FCA, but the main application and the main time-consuming part of that process will be the buyer's own application. The FCA will want to know who the beneficial owners are, who the individual people on the ground are that's going to be controlling that entity, and they'll want to know what the buyer's future plans are for the business and what their sort of business plan looks like. It's also important to plan early, because if you don't know what approvals and notifications are required from the FCA, and you only find out later on in the transaction because someone suddenly realised that one of your indirect subsidiaries is authorised, it will impact your timing. And I say impact timing, yes, that's a delaying factor, but anything which delays transactions also adds to your costs. So it's important to get the right advice up front, work out what permissions the regulated entity has, who needs to make what type of notifications to the FCA, and then you can build that into your transaction timetable right from the beginning. Okay, yes, share purchase agreements are a key transaction document. They're never that short, unfortunately, but they are the key document on transaction because they will set out how the deal is expected to be structured, who has to do what, either before closing or post-closing. I suppose the key things from the seller's perspective that they include in there, well, price, as they will include how you've determined the price, whether that's based on a multiple of EBITDA type model, or whether you valued the business based on the amount of recurring or other revenue in the business itself. And getting that right and having that clear in the document is really key to avoid any disputes or issues further down the line. Other areas which are important to sellers will be what's called the restrictive covenants. So these will be your non-solicitation covenants and your non-compete covenants. And again, really understanding early on whether or not those types of clauses will be important to you as a seller is key. If you're looking to retire, for example, then you're not going to really be that interested in how restricted you are post-completion to enter into that enter into a similar market or anything of the like. However, if you're not retiring and you're planning on setting up your own new business, or if you are looking to not necessarily start your own business but join a competitive business, then those type of clauses will be very important to you, and you'll want to make sure they're negotiated properly. The sale and purchase agreement will include warranties or statements of fact as to the state of the company or the business you're selling. They are very important to the buyer. I think it's important for sellers to recognise that. And they will give the buyer comfort that actually it knows what it's buying. So this is why the diligence process at the start is really important, because if you've done a proper diligence process as a seller, then when it comes to the share purchase agreement and the giving of warranties, actually at that stage you're really just repeating back and telling a buyer what you've already told them at the front end. So at that point there shouldn't be any price chips, or at least you hope so. Spoiler alert, warranties are never short. You're never going to get one page of warranties, so do expect a number of pages of warranties, but yes, nothing to be too scared of. The other key area, and I think this is probably one of the most important areas in an SPA from a seller perspective, are the limitations on liability. So you've worked for decades building up the value in your business. You've found your perfect buyer. You've sold the business to them. They've paid you hopefully a large or suitable sum of cash for selling that business. What you want to do is make sure that once you've received that cash, you don't have to then give it back. So there are key terms in your SPA which will deal with what your maximum liability is, when you're liable, how long you're liable for example. And those are all very key things to negotiate and get right up front in a transaction and within the SPA itself. Warranty and indemnity insurance can be useful to minimise a seller's risk here. So we've talked about a seller being liable, having sold, or potentially being liable, having sold its business. What warranty and indemnity insurance does is it allows the buyer to have recourse against an insurer rather than against the individual or the person that's just bought the company from. That means that when the seller receives their cash, absent certain minor exceptions such as fraud, etc., your seller will be able to keep their cash and not have to pay anything back should things go wrong. So it's a good thing from a buyer's perspective. They at least know that if something goes wrong, they can have recourse against the insurer. From the sell side, they know that actually once I receive this cash, I know I can go away and spend it. And so it can be a useful tool to ensure that, both from a buy side and a sell side, that risk is mitigated, etc. Key point comes down to, well, who's actually going to pay for this policy? And that really does come down to the commercials and the agreements at the time. There certainly are though arguments that these types of insurance policies benefit both the buyers and the sellers. So in a lot of circumstances, the insurance premium can be shared between the parties because they see there's a mutual benefit. But certainly something that we see more often in these cases, and particularly in financial services businesses themselves.